Different types of investments. Stocks. Owning a piece of a company and benefiting from its growth. Bonds. Essentially lending money to a company or government and earning interest over time. Mutual funds. Pooling your money with other investors to buy a diversified portfolio of stocks and bonds, managed by a professional. Welcome to my channel. Today, we're breaking down the basics of investing, demystifying the process, and helping you take the first steps toward building your wealth. Whether you're completely new to investing or just looking to brush up on the fundamentals, this video is for you. Make sure to watch until the end as we cover everything you need to get started. Let's start with the basics. What is investing? Simply put, investing is the process of putting your money to work for you. By purchasing assets with the potential to increase in value over time, this could include stocks, bonds, real estate, or even starting your own business. The goal is to grow your wealth over the long term, outpacing inflation and achieving your financial goals. Why should you invest? While saving money is essential, it's only part of the equation. With interest rates on savings accounts typically lower than the rate of inflation, your purchasing power actually decreases over time if you're only saving. Investing, on the other hand, offers the potential for higher returns, which can help you achieve financial goals like buying a house, funding your child's education, or enjoying a comfortable retirement. Different types of investments? Now that you understand why investing is important, let's talk about the different types of investments available. Stocks. Owning a piece of a company and benefiting from its growth. Bonds. Essentially lending money to a company or government and earning interest over time. Mutual funds. Pooling your money with other investors to buy a diversified portfolio of stocks and bonds, managed by a professional. Real estate. Investing in property to generate rental income or profit from the appreciation. Each investment type has its own risk and return profile, so it's crucial to understand these before making any decisions. Understanding risk and return. One of the most important concepts in investing is the relationship between risk and return. Generally, the higher the potential return of an investment, the higher the risk you'll need to accept. Low-risk investments, such as government bonds or savings accounts, offer lower returns but are safer. High-risk investments, like individual stocks or cryptocurrencies, offer the potential for higher returns, but can be. The key is to find a balance that suits your risk tolerance, financial goals, and time horizon. The power of compound interest. Now, let's talk about one of the most powerful forces in investing. Compound interest. Compound interest is when you earn interest, not just on your initial investment, but also on the interest that your investment has already earned. Over time, this can lead to exponential growth in your portfolio. The earlier you start investing, the more time your money has to compound, which is why starting early is so crucial. Now, let's talk about the different types of investments you can make. Stocks. Owning a share of a company. When the company does well, the value of your stock goes up. But if the company does poorly, the stock value can decrease. Stocks are known for higher risk, but also potentially higher returns. Bonds. Essentially a loan to a company or government. They pay you interest over time, making them generally less risky than stocks, but with lower potential returns. Mutual funds. These are collections of stocks, bonds, or other securities. They offer diversification, meaning your money is spread across different investments, reducing risk. Exchange-traded funds, ETFs. Similar to mutual funds, but traded like a stock on the exchange. They combine the diversification of mutual funds with the flexibility of stocks. Real estate. Investing in property. This could be residential or commercial real estate. It often requires more capital up front, but can provide steady returns through rent and property value appreciation. Commodities. Physical assets like gold, silver, or oil. Commodities can act as a hedge against inflation, but are often more volatile. Cryptocurrency. A digital currency, like Bitcoin or Ethereum. This is a newer high-risk investment that can offer high rewards, but also comes with significant uncertainty. Diversification. Diversification is a strategy that helps you manage risk. By spreading your investments across different asset classes like stocks, bonds, and real estate to reduce the impact of any one investment performing poorly. It's the financial equivalent of not putting all your eggs in one basket. If one investment loses value, others may gain, balancing your portfolio. How to start investing? Ready to start investing? Here are the steps you should follow. Set your financial goals. What are you? Retirement? A house? Education? Your goals will guide your investment choices. Establish an emergency fund. Before you start investing, make sure you have an emergency fund with at least 3 to 6 months of living expenses. This ensures you don't have to sell investments in a downturn to cover unexpected costs. Choose a broker or investment platform. Decide where you'll manage your investments. Many online platforms offer low fees and user-friendly interfaces for beginners. Start small. You don't need a lot of money to start investing. Begin with what you can afford, even if it's just a few dollars. Many platforms allow you to buy fractional shares of stocks, so you don't need to buy a whole share. Automate your investments. Set up automatic transfers to your investment account. This way, you consistently invest over time, which is a strategy known as dollar cost averaging. Monitor and rebalance. Regularly check your investments to ensure they're aligned with your goals. Rebalance. If necessary, this means adjusting your portfolio back to your desired asset mix. Common investing mistakes. Even experienced investors can make mistakes. Here are some common ones to avoid. Trying to time the market. It's tempting to buy low and sell high, but timing the market is extremely difficult, even for professionals. Instead, focus on long-term investing. Ignoring fees. Investment fees can eat into your returns over time. Pay attention to the expense ratios of mutual funds and ETFs, and choose low-cost options where possible. Emotional investing. Making decisions based on fear or greed can lead to poor outcomes. Stick to your plan and avoid making impulsive changes to your portfolio. Not diversifying. Putting all your money into one stock or asset class can be risky. Diversify to spread risk. Neglecting to. Over time, some investments will grow faster than others, shifting your portfolio's balance. Rebalancing keeps your investments aligned with your risk tolerance and goals. To wrap up, here are a few final tips. Start early to take advantage of compound interest. The sooner you start, the more time your money has to grow. Keep learning. The more you understand about investing, the better decisions you'll make. Stay patient. Investing is a long-term game. Don't get discouraged by short-term market fluctuations. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any of our future videos. Leave a comment below if you have any questions or topics you'd like us to cover. Happy investing! See you in the next video.